Morning, everyone. This is Paul Duncan with GammaEdge. Today is Tuesday, the 22nd of February. Overall, still seeing a lot of bearishness. Expect a lot of volatility today. We start with the market. This really sets how you should be positioning yourself. Taylor's market view in the GammaEdge Discord under market status will give you a pretty good review of where we've been and potentially where we could be going. On the short term, long positions, risk off. There's no reason to go long in any sense here. Of course, you can always scalp, but that's scalping. That's not really what we're doing here. If you're not a good scalper, I wouldn't go there. In terms of short positions, the bounces can be shorted, but be nimble. We are in a position where we could reverse pretty quickly if those puts get closed, and the dealers have to respond accordingly by covering or buying the futures. In the medium term, we still see terrible breadth, as indicated by the 52-week new high, new low model. It's been terrible for a while, and we're just unable to break out of that. This tells us that stocks are in a downtrend on a broad scale, and so we need to pay attention to that. Longer term, definitely bearish. We've got a downward slope, as you'll see, of what we call the moving average ribbon. The ribbon's inverted, we're well below it. There's nothing here that says position yourself for the long side. Not yet. We'll need the short term here to reverse before we get any indications of a long-term bull, and we're not there. The ES has been pretty active. Positive transition has moved down to 45.65. It was up at 45.85 or so. This indicates that overhead puts have been closed. That actually can be somewhat bullish. Unfortunately, though, the monetization has already occurred. Those puts being closed has already fueled whatever move one way or the other. And so there's really no additional fuel for an upside swing. We are below what we call the complex zeros. These are the balancing or the tipping points within the ES structure, and those are at 44.37 and 44.64. And until we close above those points, the ES is going to be bearish. As far as the VIX and the volatility of the VIX, it's elevated as you would expect, and the VIX is still in backwardation, fairly strong backwardation. Which means the front month is more expensive than the second or back months. The VIX is approaching the 1 standard deviation from below, and the VVIX is now above the 20-day MA, which are both elevated levels. The SPX, we are in a net negative regime pretty strongly and deeply in this net negative gamma. We have really high volatility priced in for today. We took the larger of the two methods that we use, and we're over 4% expected move being priced in. Today is a weak 0 DTE today, and it indicates most likely that intraday trading will drive us. So volume today, puts being opened and closed, calls being open and closed will drive much of the SPX price movement. When we take a look at the market status, I think it's important to acknowledge that Thursday was our first tell here at Circle 1. We didn't continue the previous 2-day uptrend. We reversed immediately out of the starting blocks. Looked like we were going to have a pause here for a while into the Euro close, but you can see here at Circle 2 where we lost the historical turning points. It was just game over from there. This Circle 2 would have been an indicator to perhaps enter a short position by ETF or by shorting the SPY or something like that. Generally, when you get this very strong down, that's a good play to look at there. Friday, of course, was straight down. We had a little bit of a pause in the afternoon, but the ARCX just continued on down in context of the cumulative tick. I will say the historical moving averages here are all in a downward slope. So this tells us that any bounce can most likely be shorted. So if we do turn up, we'll need to clear this area for any sustained bull. You can see we're pretty far down below. And the Circle 3 indicates that we're at what we call railroad tracks. When you get these short-term moving averages all in parallel, that's usually a free fall mechanism, and we'll have to see what happens there today. The ES, as I said earlier, the positive trans has dropped a little bit, not a lot, but negative trans is sitting down here at 43.35, and the zeros are where you expect between positive trans and negative trans, and they're sitting in the middle there. We need to really start pushing aggressively above this area if we're going to have any sense of going long for any sustained period of time. The nice thing is that we are seeing a confluence of the +1 standard deviation of VWAP on the ES starting to converge here with minus trans. When that translates over into the SPX complex, we typically have got a number of things coming into support, and we'll want to watch that. The structure underneath, the minus GEX structure, which is the negative gamma exposure, as well as the put open interest, are unchanged. And you can see volatility did fall overnight, but it's still very elevated at 29.23 when I took this picture. When we take a look at the overall SPX and the SPX combo, you can see really in the big picture that extreme volatility is being priced in, over 4%. I know many of you say there's not a chance we're going to do 4%, but we do actually go 4%, 3%, whatever the numbers are intraday. So close to close, I agree, that is true, we won't, but intraday we certainly can. I've boxed here the expected range. I don't think we're going to go much higher than the 45.10s. That's where the JPM long puts. There's 43,000 of them stand up there. There's actually 47,000 open interest, but we know 43,000 of those are long on the JPM side and are short on the dealer side. We don't know about the other ones there. I think that's a key thing to watch. The nice thing here is that we've got a lot of support on both the PM settled and the AM settled at 4250 and 4200 with some pretty significant magnitudes. Obviously not as strong as the overhead, but nevertheless, I do see a good amount of support to break down below 4200. So I'm not expecting that we're going to go south. If we do, the next stopping point you can see in the SPX complex, 41 and 4000 both have some support there. When we take a look at the 0 DTE, net negative is coming off today. Very weak though here at circle 2. I think that's important. We're really at the fulcrum of which way we could go. We do have the dominant calls are expiring here at 4450, and the dominant puts in terms of gamma exposure are down here at 4300. Relatively high magnitude, so if we do fall, we lose some of the support, and that exposes the 4250 as being the next dominant level for today's expiry. Up here at circle 5, 4450 again corresponding to the COI. This is the dominant positive gamma that's expiring. Doubtful we're going to push much above this, but if we do push through the transition range indicated here by square 6, we'll probably hit this area here, which will become sticky and a lot of monetization starting to occur as people try to get untrapped here. I do think the transition range is indicated here by square 6. This would be a natural area for the dealers to go to. Into the close, we'll just have to see. The reason I picked this area is because we've got a lot of transitions back and forth, and historically we've seen the dealers try to drive price towards those areas. When we take a look at the amount of gamma that's coming off below spot price, you can see that the end of the month actually has the dominant here, and this week actually isn't that strong. The levels aren't very big. Simply stated, although today is bigger than tomorrow, it's not all that great. I'm not anticipating, and as you saw earlier, we're right at the fulcrum. I'm not anticipating a lot of fuel here to push us aggressively higher up the strike chain. Finally, when we take a look at the SPX combo complex, very, very negative overall gamma condition and very deep hole that we're in right now, as we talked about earlier. 4300 on the mothership complex is dominant, and so that should offer a lot of liquidity at that area. As we drop on down, we might see some monetization of the puts that are above it. If we do, that could fuel us back. If we don't, and people start, if we lose anything at 4,300, we could start opening puts down here, which will pull us down even further as the dealer sells as puts are open. So we'll just have to see what happens there. I do think the 45.10, 45.20 area is a sticky area. You can see as we push through this transition range, and then we hit a ceiling here. And this is the JPM hedges that I talked about earlier. Of note here is Circle 5. We have a tremendous amount of gamma, more than we had here in February, coming off in March. 26% in the March expiry alone, and then you can just tally all of this through here. North of 40 some percent, and we'll have to see how this number builds or doesn't as we go through March. So something to take note of. A final thing I want to draw your eye to for the mothership complex, you know, the big $6 trillion complex, COI has dropped from 4,700. So the dominant call structure was all the way up here, and now it's dropped down below. So we've lost a lot of calls up here with the February expiry, and that can be a storm cloud on the horizon. So just be aware of that. So that's the end of today. Cautions advised, of course. A lot of volatility expected. Come join us over at GammaEdge.us. If you click on this link, it'll take you over to a sign-up page where you'll have a 14-day free trial, risk-free. Gives you a chance to kick the tools and also see some of the edge-related work that we've been doing. Definitely have been able to now start some back testing back to 2013 using Gamma, and the results are very, very interesting. And of course, you can reach out to us on Twitter at GammaEdges with an S, and leave your comments and suggestions. Be safe, everyone. Thank you.